Tom Bowley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this, Tuesday, August 27th, 2024 edition of Trading Places Live. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for another trading day. Hard to believe August is almost gone, heading into September. Seems like 2024 going to be ending here soon before we know it. We have had some, good news of late since the last show last week. Of course, we had the Jackson Hole, Wyoming Economic Symposium. That's where Fed Chief Jerome Powell gave his speech, his annual speech from Jackson Hole. And like the bomb he dropped 2 years ago when he said more pain ahead, he actually went the other way this time and said things are actually looking pretty good and it's time to change policy. So kind of giving the green light for rate cuts starting in September. Now the question turns to how big are these rate cuts going to be? How often are we going to get them? Is it going to be something that's going to stretch into 2025? Could it go into 2026? I know many months ago when the Fed was talking, they were talking about rate cuts for a couple of years. Whether or not that's still what they're thinking, I don't know. We're going to find out more at the next Fed meeting. But at least we do have that confidence, or we should have that confidence now, that the Fed is going to start its rate cutting campaign. So in other words, they are signaling that they feel extremely comfortable that that inflation is now in check. They were adamant that they were not going to cut until they felt like inflation was on its sustainable path toward its 2% target. I guess something triggered them. Didn't, from 6.7% down to 3.3% wasn't sustainable, but I guess something happened in the last 30 days or 3 weeks that they feel has now led them on that sustainable path. So good news is the rate cuts, which have been talked about in the media, which have been talked about really on the charts. We've been talking about it for a long time, saying that they were coming. There's been a lot of disappointments along the way, but according to Fed Chief Powell last Friday, they're coming, and now the Fed is on board. So that's a good thing. Always nice to see the Fed finally seeing what the bond market's been telling them they should be seeing for a long time. But hey, I guess late to the party is better than not going to the party, right? Anyway, let's move on. Let's take a look at what happened yesterday. So we had the Dow Jones Industrial Average finish up roughly 65 points. Let me zero in here for you so you can see this a little better. Dow Jones up 65 points. We did hit an all-time high. So we have now moved up to all-time high territory on the Dow Jones. Now, the other major indices have not yet followed suit, but they're not far from it, especially the S&P, which we'll get to next. S&P down 17 yesterday, but you can see got up into the mid 5600s recently. We need to get up and clear. I don't know exactly what the number is, probably somewhere around 5680, 5690 in order to set a new all-time high. We've been close. We're getting there. But actually, technology in some of the more aggressive areas are what's kind of holding us back from reaching those new heights. So anyway, S&P 500 down a little bit, but still, you can see we've got a golden cross now, that 20-day coming back up above that 50-day moving average. That's always a bullish thing. That's where good things happen. Usually when the 20 is above the 50, bad things tend to happen, or at least the odds of bad things happening grow once you get that death cross where the 20 goes below the 50. You don't want to be living in that world for very long. But the good news is the S&P has bounced back, and we've now seen that golden cross. NASDAQ 100 losing 1% yesterday. So again, a little bit of relative weakness, and you can kind of see it just on the chart. Look at the NDX and how far we are off of the highs. We're clearly right now more than 1,000 points, which is still more than 5%. We're probably somewhere in the 6% range off of the highs. We were almost at the highs on the S&P, and the Dow's already broken out. So you can see that relative weakness on the NASDAQ that I was referring to. And this is the group that in big secular bull market moves to the upside, this is the area of the market that tends to lead. So when we're getting breakouts like we are on the Dow Jones, or when the S&P 500 is strengthening, and we're not really seeing that same strength on NASDAQ, what it just tells me is that gains are likely to be less robust. So when we saw huge moves up in technology and big moves up in semiconductors, that was the recipe for big moves up in the S&P 500, because those areas of the market are much more heavily weighted. If those areas are not performing well or not going along for the ride to the upside, then it's going to take a smaller piece of the pie on the S&P 500 to drive prices higher. It's going to be much more difficult to go up a lot if your biggest components are not doing well. So that's what we've got, I think, to look forward to here over the next couple of weeks, maybe to a couple of months. I'm fairly confident at this point that we're not going to go back down below the August low. We do have a huge report coming out from NVIDIA tomorrow evening. I mean, if they were to miss, obviously many of the semiconductor components right now are already struggling. So to think NVIDIA might join that group or may even accelerate that move to the downside, semiconductors are a big part of the market. 11% of the S&P 500, 25% of the NASDAQ. That's a lot. So if you get a group like that that's struggling, has a major leader come out with a bad earnings report, then yeah, things could turn down much more quickly. And so we certainly would have to evaluate that and see if the entire market is going down in sympathy, or if it's just certain growth areas that are going down. Because if value stays up and continues to move on like nothing's happening, you got financials breaking out to all-time highs. I talked about the Dow Jones. Industrials coming back nicely. Staples, many of the value areas, defensive areas of the market on an absolute basis are still staying up at or near highs. Those companies could continue to do well, even though growth stocks take a break. I mean, after all, when we went up, it was growth stocks leading, right? Growth stocks were absolutely on fire. Semiconductors were exploding. And everyone was complaining about the fact that we had lack of breadth. It's going to be interesting to see if things kind of flip here over the next couple of weeks to a couple of months, where those, large cap areas like semiconductors perform poorly, but then the broad market does much better. Be interesting to see how folks believe, in the market, or how much they talk about the market. Because everybody likes to be negative in the media, because, hey, frankly, that type of news sells. I mean, again, that's why when you turn on the TV and the news, you don't see the Boy Scouts going around doing their thing. Instead, you see the train wrecks and, the people, you want to see the bad stuff. That's what sells. That's what draws in viewers. I can tell you, if I write an article at Stock Charts and it's a bearish article, I'll get 3 or 4 times the views that I get if it's a normal, we're in a secular bull market kind of article. People gravitate toward bad news. Anyway, so if things change and we see semiconductors going down, is that all of a sudden going to be the problem? It was the exception when we were going up. Everybody wanted to talk about the broad market. But what happens if the broad market does well and semiconductors sell off for a while, and growth stocks in general sell off for a while? It's going to be interesting to see how all that gets spun. For me, hey, if the market's going up, if the S&P is going up, NASDAQ's going, well, maybe not NASDAQ, but the Dow's going up, some of these other areas that haven't performed well for a while start outperforming. I really don't think that's a bad thing. It's a baton being passed. It's rotation, bullish rotation. Anyway, midcaps. Midcaps down 10. That's about 1/3 of 1%. Look at midcaps trying to break out. Little different picture on midcaps than on the NASDAQ, don't you think? We had a huge sell-off, and actually even bigger sell-off in the midcaps, going down to a 6-month low than we saw on the NASDAQ. I mean, we went from a high, and in 3 days, midcaps were just absolutely trounced. And now we've worked our way all the way back up, ready to break out potentially new highs. Semiconductors were already, semiconductors were, but the NASDAQ, because of semiconductors and some other growth areas, the NASDAQ was already down. Second half of July was very weak. Second half for midcaps was very strong. Why? Well, remember that CPI report that came out on July 12th? And we kept talking about how small caps and midcaps were exploding and that this was a sign that rates were going to go down. And then, of course, the Fed came out. I mean, it's amazing to me how they switched from the end of July to what they're talking about in Jackson Hole just a few weeks later, 3-4 weeks later. But in July, it was just that rate cuts would be on the table. 3 weeks later, I don't know what happened. I guess obviously we moved sustainably toward the target, I guess, in those 3 weeks. But now Fed Chief Powell's on board, says, hey, we're going to be cutting rates, basically. I mean, if I'm going to paraphrase, that's exactly what he's saying. We're going to cut rates in September. He said it's time for the Fed to change its policy. So anyway, look at what midcaps are doing, though. Now that we got past that August 5th shellacking to the downside, now midcaps all of a sudden much more back in favor, more so than the NASDAQ. Anyway, IWM, small caps, same thing. Maybe not quite to the degree of midcaps, but still pretty close, getting back up into the 220s. 228 was that recent high right before the Fed meeting. Took that big tumble, went down about 15% in 3 trading days. And then we rallied all the way back, got most of those points back. I suspect we're going to see relative strength from the small caps, but I've been wrong about that throughout much of 2024. We'll see whether or not the fact that the Fed has actually said, hey, we're ready to start cutting rates. I would think that that's going to have a big impact on the small caps, but we'll see. We'll watch it every day together. Transports moving back up, which is a good sign. Of course, interest rates should eventually strengthen the economy. We should be shipping more goods. And as a result, transports bouncing and moving up closer to the July highs, although not breaking out yet. I'd like to see transports break out. We got the Dow that's broken out. I'd like to see transports break out. I'd like to see the small caps, mid caps break out. Let some other areas kind of take leadership role for a little while. I think into year end, maybe even into the first quarter of next year. I certainly don't think that's out of the question. We could see pretty significant outperformance by some of these areas, especially small caps that I like. But again, we'll be looking at it day to day and we'll be checking it out. Moving on. Whoops, went too far. There we go. Energy leading yesterday, up 0.9%. Energy also recovering off of that August 5th low, not quite getting back up to the recent highs. And you can see energy actually topped all the way back in April, early April. So this has been a group that's been lagging for quite a while, but it at least is starting to get its feet under it. I'd like to see a breakout above about 94, 95. But until then, we're probably range bound. Technology, here's the technology group. Big sell-off beginning of August, but we've come roaring back, gotten back up above the 20. Notice, though, the 20, we haven't gotten that 20 cross over the 50 yet. So no golden cross here. And as I said, a lot of bad things happen with the 20 below the 50. NVIDIA coming up. It's going to be two, one being a technical sign, the 20-day, watching to see what happens there. But the other fundamental, which obviously once the report comes out, we'll see what the charts say and how the market reacts to the report. But if you get a good report on Wednesday on NVIDIA, I would expect that we're going to gap up somewhere close to the recent high. I mean, if the numbers are really good, if we break out above on the open, I think that would be bullish. If we are up close, can't get the breakout. I'm looking at technology, but I'm also talking about NVIDIA as well. NVIDIA, I think the number on that chart is 140. Don't have it up here right now, but 140 is the level we want to look at on NVIDIA. Technology is closer to 240. But if we can get breakouts on both of those, that would certainly change the dynamics of the market. Doesn't mean technology would lead, but it would mean that they are breaking out again, which is always a good thing when you're moving to all-time highs. Discretionary. Yesterday, not so good. And by the way, technology was the worst performer yesterday, down 1.25%. Discretionary not too far behind, down about 0.75%. Also rallying back off that August 5th low, which was the low of the last 6 months. So discretionary on a relative basis performing very poorly. But the group has bounced back really nicely here in August, back up above the moving averages. The 20 now turning up and trying to clear back above that 50-day. We'll see whether or not it can do that. But we've got gap resistance. We've got the recent price high coming in right around 188, 189. So that's going to be the initial challenge for the XLY, trying to get through that level. Aluminum had a particularly good day yesterday. It was the top performing industry group, gaining almost 2%. Moved back up, testing its 50-day moving average from underneath. Can it get through? Well, we're going to see. You got to get through 121.26. And we finished at 118.06. It looks like we got up just above 120 intraday. I'd have to look at the individual chart to see exactly. But anyway, right now we are parked just below that 50-day moving average. So for aluminum to begin maybe to right the ship, got to get through that 50-day. See if we can do that today. Semiconductors. So semiconductors down 2.5% yesterday. This is the problem child for the market right now, if you will. This group topped back in June, wrote an article that day and said the top is in unless we can get through that candlestick, which is up close to that 21,000 level. We have not been able to do it. We rallied off the 20-day one time and then had another bearish engulfing candle. That sent us all the way down to the August 5th low. Now we've rallied back up, but we still got a lot of work to do here on the semis. And a big part of this is going to be NVIDIA. But if you strip out NVIDIA and you look at some of the other semiconductor stocks, many of them, especially the semi-equipment manufacturers, Applied Materials, Lam Research, KLA Corp, although not as much on KLA. KLA's shown some relative strength. But those stocks, some of those stocks, I mean, Applied Materials near 100 or 200 and, was it 260 or 160? I'm getting all the numbers mixed up. I think it was 260. And that stock's back down under 200. So, I mean, that's a pretty nice haircut. I mean, the stock's down, what, 63? It's probably 23%, 24% down from its high. So you've got some semiconductors that were performing really well that are really getting beat up. Part of what's going on, the reason that we see the semiconductors doing well, number one, NVIDIA isn't too far from its recent high, which is good. But there are other semiconductors like Texas Instruments breaking out the new highs. So you've got some of the, I don't really like to use value oriented when I talk about semiconductors, but if you're looking at the group as a whole, I would say Texas Instruments is one of the more value oriented semiconductors. They pay a nice dividend. They usually don't go running crazy when semiconductors go higher. They're a little bit more stable over time. But anyway, they're breaking out the new highs. So there are a couple of pockets of strength within the semiconductors, but a lot of the names that I like to follow and that many of you probably follow as well, you know, the AMDs, the Applied Materials, of course, NVIDIA still hanging on, doing pretty well. Broadcom, I mean, some of the others, you know, still struggling. And Broadcom, by the way, I think reports next week, if I'm not mistaken. So we got another one coming up next week in the semis. But anyway, both of those companies, NVIDIA and Broadcom, both have the ability to help revive the group. We'll see how these reports come in. But remember, NVIDIA is Wednesday. Autos, you can see also still downtrending, I would say, trying to maybe put in the right side of a neckline, although it's still down sloping, which I don't like. So this is a group that I believe still struggling quite a bit. We were up probably to about 960, 970, and now we're at 780. So we're still way off the highs. And of course, most of this is because of Tesla. Tesla is well off of its highs, continues to be challenged in its day-to-day trading. And as a result, it's kind of pulled the entire auto group down with it. But the 20-day still below the 50-day moving average. I don't know if we're rolling over here or not in the autos. I imagine if growth stocks, if semiconductors roll back over, I imagine that some of the other growth areas like the autos would roll over with it. But we'll see. AD line on the auto group, not very strong. Still kind of struggling. I'd like to see that getting up closer to that July high with this move back to the upside, but we're not seeing that. So just a lot of mixed signals, but mostly negative still on areas like the autos. I've pointed out recently too that the best period of the year for growth performance versus value performance is from May through August. In fact, let me go ahead and I'll show you that seasonality chart. So if you take the IWF seasonality, compare it to the IWD, and I'm going to go back 12 years, which is how long this bull market's been roaring since we broke out on the S&P above the 2007 high. This is what we've been looking at over the last 12 years. May, June, July, and August. Let me zero in here. This is the average outperformance for each of these 4 months since 2013. So growth is outperformed by an average of 1.2% in May, 1.4% in June, 1% in July, and 1.6% in August. Add those up, that's 5.2%. So growth has averaged outperforming value by 5.2% during these 4 months, these 4 consecutive months. This is where growth has a history of doing very well. We get past August, and all of a sudden, the balance of the year, September to December, we go down 1.6% over the next 4 months. So this is the period we're getting ready to go into September. This is a period where we tend to struggle in terms of growth, and we tend to see more relative strength in value. Go to the beginning of the year, those first 4 months before May, and you can see a little bit of strength in the first 4 months, but not what we see in the next 4 months. But starting beginning of the year, we can start to see growth coming back a little bit. But no doubt May through August is where growth makes its biggest impact. And we're, 4 days away from that period ending. And so some of the rotation that we've seen and we've talked about into value, I think a lot of it is Wall Street knowing the history of the market, Wall Street knowing what's probably coming down the road, which is more strength from value, less strength from growth. And I think we're seeing that repositioning. Makes perfect sense. If you've been in growth and you've ridden up those semiconductors, I mean, you might say, well, semiconductors are, they've been really beaten up. Well, I think if you keep perspective in mind, you would realize that from October, when the Dow Jones US Semiconductor Index was under 9,000, from October to June, it went from 9,000 to 21,000. 133% in 7.5 months. That's a lot. We're still more than a double in less than a year from last October to where we are right now. We're still more than double where we were on the semiconductors. So don't get caught up in this. Well, semiconductors are really weak right now. Yeah, but it's profit taking. They deserve some time off. It would be great, I guess, if they go up every single day and the market just goes to the moon. But that's not sustainable over time. So the more you go up, the more pain you're going to feel during the subsequent period, which could be sideways consolidation or could be selling. We may not be done on semiconductors. Again, there's a lot riding on this NVIDIA report and then Broadcom next week, because a lot of other semiconductors have already rolled over and are not trading very well. So if we were to somehow get negative surprises on those two companies, I could easily see an August revisit on semiconductors, that August low. I could even see potentially down to the April low, which would be down below 14,000. And we're sitting at 18,000 right now. So there's still a lot of risk in this group. Don't think otherwise. All right, let's take a look, go through some of these other indices. I spent a lot of time on that, but wanted to get caught up on some of those indices and where we've been seeing strength, weakness. Anyway, 10-year Treasury yield, let me give you an update. We are currently at 3.86%. So we are up about 4.5 basis points this morning on that 10-year Treasury yield. Still, though, in this downtrend. Moving on to the S&P, we already talked about it quite a bit. I'm not going to spend any more time on it here. Nice little rally off of that August 5th low. Same goes with the NASDAQ, but we haven't seen that golden cross yet. So the bulls would like to see more strength, like to see that golden cross. And quite honestly, it might come down to NVIDIA, whether or not we see that. Small caps, the 20 never went below the 50. We never had a death cross on the small caps. So I think that alone tells you that that's an area of the market where momentum has remained fairly strong, even though we went down. That going down was only 3 days. I mean, if you wipe out those 3 days since July 12th, the small caps are going absolutely crazy. And most of this selling was on gaps. There was only this one really big selling day, which happened to be right after the Fed meeting. That's when the market Wall Street threw up its hands and said, we don't know what the Fed's doing. And so we saw that big move down intraday. That was actually some distribution. But the next 2 days, Friday and then the Monday, 2 hollow candles. That means we gapped down and we actually finished above where we opened. There's not a whole lot of selling taking place there. So when I look back to that CPI report, June CPI report, that changed everything in my mind for small caps, as of July 12th, we have basically been going straight up. We've had one bad day and then two big gap downs. Otherwise, I mean, we were going up, went through this period. Now we're going up. It's been relentless. But again, there's a couple of gap downs kind of mask what I think is underlying strength on the IWM. But again, that PPO moving back positive and the 20 staying above the 50, I think that's all good news. Really what we want to see here out of this group is a close over 225, intraday move through 228, 229. Let's go up and let's test that all-time high, which if we go back and look over the last 5 years, you will see it's up at about that 235 level. So got to get through this 225 to 228 range. Once we do that, then we've got our ultimate test closer to 235. And if we get through that level, we are in sky's the limit for the Russell 2000. Earlier in this year, I was calling for a big move in the small caps based on rates coming down. That got kicked down, that can got kicked down the road a couple of times, but now the Fed's finally acknowledging it. And I think, again, I think what we're seeing in small caps is likely to continue, with maybe 20-day tests along the way. That's what I'd be watching for on the downside with the small caps. Transportation stocks, more sideways consolidation. I mean, I don't know that it could get any more boring, but boring is not good when the market's been going up all year. You don't really want to see sideways action. So clearly, transports have been lagging for a long time. We have seen similar action on the transports, though, since that June CPI came out on July 12th. We had a big move up, pull back, maybe even like a little bit of a cup, and then the meeting. I mean, it could have been a breakout, and instead we went the other way after the Fed meeting, just like the small caps, 3 days down to multi-month lows after literally being at the 52-week high. 3 days. And then here we come, right back up again. So I think it's going to go higher. I think it's going to break out, but you know, there have been so many failures going across here. I don't blame anyone for wanting to see it first. All right, one thing I want to do before we wrap up, I want to show you, I talk a lot about my below the surface signals. I mean, I look at, a lot of the growth versus value, a lot of my sustainability ratios, intermarket relationships, talk a lot about sentiment. But today, what I wanted to do is just in these next 3 or 4 minutes, right before the market opens, is just show you kind of how I look at an index like the S&P 500. And I look from a big picture and then I start to zero in to give myself a better understanding of what I think is the more likely course for the market, so that I already have it in my head before I start hearing news and everything, and I start seeing the market action. It's just a way for me to maybe focus on that bigger picture and kind of see how the small picture, the short-term picture fits into that big picture. So what I'm going to start with here is the monthly chart. Now, those of you who are members at Earnings Beats know I weekly show you that 100-year chart on the S&P 500. That is truly the big picture chart, and which is, easily, you look at that every week and you can easily see how we are still in a secular bull market. Forget about what everybody's talking about, bear market this, bear market that. Yeah, we'll have a cyclical bear market from time to time, but we are in a secular bull market, and it is crystal clear on that long-term 100-year chart. Anyway, this is maybe the next best thing. This goes back about 15 years. It's monthly. Notice the PPO came down, basically hit the zero line at the same time. Price action hit that 50-month moving average. To me, that's a reset. PPO from a long-term basis back down near the zero line. We got a 50-month SMA test. We got a reset on our hands. So now as the PPO is going higher, I hear a lot of people will, write into me. I've had questions come in and say, well, what about the long-term monthly negative divergence? And I look at it and I see exactly what they're looking at, because textbook, it's a negative divergence, right? We got a high here. We got a lower here. So we got a lower PPO and we got higher prices. By definition, negative divergence. It's not the way I use negative divergences. Negative divergence, think about it. The negative divergence results from your 12 and 26 period moving averages, right? It's the short-term moving average and the long-term moving average. When the short-term is above the longer-term moving average and it's pulling away from it, that's when your PPO goes up. PPO goes down when the opposite occurs, when that short-term moving average starts to slow, but the longer term moving average is still going up or maybe flattening. And so you end up seeing a lower reading on the PPO, even though price action keeps going up. That's a negative divergence. When you get the PPO back to the zero line, what does that mean? It means that your short-term and long-term moving averages have no momentum. They're both at the zero line, or they're even. So if your 12 period and 26 period moving average are exactly the same, is there any momentum to be reversed at that point? You already reversed, you're back to zero. So when you start moving up off of zero, to me, your momentum is starting to build again. It has nothing to do with what happened on that prior high. That just doesn't make sense to me. Let me show you something. If we go back, I show this every once in a while, but if we go back and we look at the NASDAQ, let's go back and look at 25 years since the turn of the century. Do you see where the PPO was on the monthly chart back in 2000? After we had that huge run up in 1999, remember that? If you were trading back then or in the market, when we set that PPO over 20, we've had nothing but negative divergences. Every single high we've had. If you go back, textbook, you got a PPO that's lower and you got prices that are higher. Why don't we say we've just been in a negative divergence for this entire century so far? And likely, maybe the rest of the century. I don't know if we'll ever get it. That was a crazy, the NASDAQ went up, 80 or 90% in 1999. So that PPO on the monthly chart went as high as we've ever seen it. So are we still in negative divergences? Are we going to always be in a negative divergence? Well, if we're not going to go back there, where do we stop? How do we know where to go back to? The PPO is not a trending indicator. It moves up and down, up and below zero, up above zero, below zero, above zero, below zero. It trends only for a period of time. And when that trend starts to slow, you'll see it in a lower PPO reading, and then we'll reset a lot of times following that. That's the way I use the PPO. So anyway, looking at that 15-year chart, I think the PPO looks great, moving straight up with price action. To me, we got bullish momentum on the long-term chart, which means any kind of a pullback to the 20 period. Now on the NASDAQ, we're at 17.6, and the 50 period is at 13,570, or no, 20, excuse me, the 20 month period is at 15,136. Well, we just got down to 15,708 in August. Earlier in August, we got down to 15,708. So we got close to that 20-month moving average. But if you look at history, a lot of times, anytime we go through any kind of semi-serious weakness, we go down to the 20-month moving average and we bounce off of it. That's been our history. When we get down to the 50, we got some real problems. So the weekly, it can't tell if we have negative divergences or not. But bottom line is we went almost right down, and this is on the NASDAQ, by the way. But on the NASDAQ, we went right back down to that 50-week moving average. So effectively, we didn't get the zero line on the PPO, but we did get the 50-period test, or just about the 50-period test. So I kind of think at best, the PPO is maybe mixed. I don't really look at it and say negative divergence. I don't look at it and say, well, we're coming off the center line, so things are starting to get bullish again on this move. In fact, as we've been moving back up, the weekly PPO is not even really budging. If anything, maybe going a little bit lower. So all of this to me just kind of reeks of sideways consolidation until we can get that PPO back down closer to the center line, kind of like we did last October before we turned right back up. Went down to the 50-period moving average, turned back up, got down to the center line, turned up. So maybe we got a little bit more work to do here in August and September, maybe into October on the NASDAQ. I don't see it quite as bullish on the weekly as I do on the monthly. And the monthly, we got room. We got room down to that 20-month moving average. So if we go sideways here on this weekly chart, it's not going to hurt anything on the monthly chart. And then there's the daily, which right now, when I look at it, I see the PPO's gone positive. We've got a nice uptrend. We've got both our moving averages just below us. We need to hold on to that. But overall, I think this looks pretty good. Now, if we roll over and we go below, then on the daily chart, I start to see weakness. But again, look back to that weekly chart. We could have weakness on the daily chart and the weekly would still be fine. Or better yet, let's go to the monthly chart. What if the daily were to roll over and the NASDAQ pulls back 500 points? Would that mean anything on this long-term chart? No. So again, the long-term perspective remains bullish. Short-term just turns challenging in my view. Last thing I'll show you is the hourly chart. So members, earnings beats. I don't know if I posted this on YouTube or not, but I know I wrote daily market reports to our members talking about these negative divergences that had developed last week. And I thought we could go through 1 to 3 days worth of, maybe some sideways to down action. Here was the negative divergence. There's the higher prices on the hourly chart. There is that PPO rolling over, negative divergence. What did we do? We went down to this center line, down to the 50-hour moving average and down to the center line. And now that negative divergence is gone on the hourly chart. No more problem. And that was, that move down there on the hourly chart. If we go back to the monthly chart, it's really like a gnat on an elephant's butt. I mean, it's nothing. Don't even know you've moved basically on a monthly chart. But the hourly played out, and now it looks like we're challenging this low. We're below the moving averages, but we still need to go below this price support area. If we do, the NASDAQ could easily move back down to this gap support, which would be 17.4. So then I'll go back to the daily. What would happen at 17.4? Well, the 20-day right now is at 17.491. So if we were to go all the way down to 17.4, we'd want to hold on to this gap support, because otherwise trading below the 20-day with the 20 below the 50, like I said, nothing good usually comes from that. So we want to limit our time below that moving average. But 17.4, if we go back out to the weekly chart, what is 17.4? Where's the 20-week moving average? 17.1. So again, it starts to look bad on the daily, but you're still fine on the weekly. And go back to the monthly, it's not even going to register. So that's kind of how I take. That's why when I talk about the market and I say, hey, I'm long-term bullish, hopefully you understand why. Short-term, sometimes I'll be cautious. If we lose the 20-day moving average, I would be cautious on the NASDAQ, just because that's not a good thing to lose the 20-day moving average. But again, it's not changing my long-term tune. We could handle moves back down to the April low, down closer to 15,000. If you go to the monthly chart, 15,000, that's where your 20-month moving average is right now, 15.1. So that would just be a normal 20-month test. Yet on the daily chart, people will be freaking out. I mean, if we go back down to 15,000 here, we're talking about going down below the April low. The April low was 15.3. If we're down below that, there are going to be people screaming about a bear market. And meanwhile, the 15-year chart, monthly chart's going to be yawning. It's going to be like, oh, okay, we got another 20-month test, EMA test. So it's all depends on how you look at the market. You've got to take perspective into account, and that's what I try to do in my analysis. So I don't really get caught up as much in the daily up-down yo-yo, because I'm grounded and I'm focused on the long-term chart, which is still telling me everything is okay. And all of this, the below the surface signals that I like to talk about and like to use in my analysis, all of those still suggest we're going higher. So I don't really have any problems with the market other than trying to negotiate August and September. Anyway, hopefully that helps explain kind of how I look at the market and why I'm a little nervous with August and September, but still very bullish in the long term. Have a great day, everybody. Happy trading.